You know, one of the biggest mistakes investors make and societies make is assuming that what worked yesterday will keep working tomorrow. We live in cycles. Everything, economies, markets, even civilizations, moves in predictable patterns over time. Right now, we're in the middle of one of the most dangerous yet fascinating transitions in modern economic history. I call it the Great Liquidity Trap. Understanding the trap deep insight tone, let's start with what that means. A liquidity trap happens when central banks pump money into the system, hoping to stimulate growth, but that money doesn't flow into the real economy. Instead, it gets trapped. Why? Because when interest rates are near zero or even negative and debt levels are sky high, money loses its power to create productivity. It just moves in circles, from governments to banks to asset markets, inflating prices but not creating real wealth. That's where we are today. We've printed trillions of dollars, euros, and yen. Central banks have expanded balance sheets to record levels. And yet, productivity growth is stagnant, inequality is rising, and inflation is unpredictable. It's like trying to revive a patient by giving them more painkillers instead of curing the disease. Ray Dalio style framework, the cause-effect chain. Now, let's step back. To understand what's happening, you have to look at the three big forces that drive these cycles: debt cycles, short-term and long-term. Internal order, the balance between wealth gaps, values, and opportunity. External order, the balance of power between nations. When all three are stretched like they are right now, a liquidity trap becomes the symptom of a much deeper imbalance. Governments borrow more to keep things stable. Central banks print more to keep debt service manageable. And investors, instead of building new productivity, chase yield wherever it hides it in gold, stocks, AI startups, or crypto. That's not sustainable. That's not innovation. That's survival. The smart money moves pragmatic, insightful tones. So, what's smart money doing? It's moving not because it's greedy, but because it's aware. Smart money is getting out of overvalued paper assets and into real, productive, and scarce assets, things that hold value when money itself doesn't. They're buying real estate in stable jurisdictions, commodities and energy infrastructure, gold and strategic metals. Data, technology, and intellectual property that generate long-term cash flow. They're not timing the market, they're timing the cycle. Because when liquidity dries up and rates stay high but ineffective, those who hold real value will survive, and those who hold only paper promises will not. The principal wisdom tone, if you understand history, you'll know. Every great financial system eventually faces a point where money creation exceeds productivity creation. That's when paper wealth stops being real wealth. In the 1930s, it was the Great Depression. In the 1970s, it was stagflation. In 2008, it was the credit bubble. Now, it's the Great Liquidity Trap, the moment when printing money stops working. And that's when capital, the smart money, moves to where it's treated best. Liquidity is often mistaken for wealth, and that's one of the most dangerous illusions in modern economics. When central banks inject liquidity into the system through lower interest rates, quantitative easing, or direct asset purchases, it gives the appearance of prosperity. Markets rise, asset prices inflate, and people feel richer, but that sense of wealth is largely an illusion because liquidity doesn't automatically translate into productivity. True wealth isn't created by printing money, it's created by producing more goods, more services, more innovation, more value. Without that underlying productivity, all that printed money becomes just numbers floating through financial systems, chasing the same limited pool of assets. When the engine of productivity slows down, and governments respond by adding more liquidity, it's like trying to fix a broken engine by pouring in more fuel. The engine doesn't run better, it just overheats. What we see today across global markets is exactly that: too much fuel and not enough real output. The result is an economy that looks healthy on the surface, but is structurally fragile underneath. Over the last decade, we've lived through one of the largest monetary experiments in history. Central banks expanded their balance sheets by tens of trillions of dollars, keeping interest rates near zero for years. Initially, that kept the system afloat after the 2008 financial crisis. It made borrowing cheap and boosted confidence. But over time, it also created distortions. Instead of stimulating real economic growth, the excess money started to circulate mostly within financial markets. It inflated stock prices, real estate, and speculative assets, while doing little to improve wages or productivity. When liquidity becomes abundant and cheap, investors stop pricing risk properly. They start buying whatever seems to be going up, assuming that the central bank will always step in if things go wrong. That mindset, what we call the Fed put, creates moral hazard. People take bigger risks because they believe they'll be protected. And when everyone is chasing yield in the same direction, bubbles inevitably form. The illusion of wealth feels comforting while it lasts. Portfolios look bigger, companies report higher valuations, and governments appear solvent because they can issue debt at almost no cost. But underneath it all, debt is growing faster than income, and productivity is stagnating. That imbalance can't continue indefinitely. Eventually, the markets recognize that there's no real value behind the inflated numbers. That's when the correction begins, and it's usually painful. You can see this pattern repeating throughout history. In the 1920s, easy credit created a surge in stock speculation, leading to the Great Depression. In the 2000s, cheap money fueled a housing boom that ended in the 2008 crisis. Now, we're witnessing another version of the same story, a global liquidity trap where money keeps flowing, but real economic returns are diminishing. Each time the trigger looks different, but the underlying mechanism is the same. When liquidity expands faster than productivity, the system becomes unstable. The hard truth is that liquidity alone can't create sustainable prosperity. It can buy time, smooth over downturns, and postpone pain, but it can't replace the fundamental need for innovation and real productivity. That's why economies that rely too heavily on money printing eventually face currency devaluation, inflation, or stagnation. It's not a matter of ideology. It's a matter of arithmetic. So when you hear that markets are booming because central banks are providing liquidity, remember that liquidity is just temporary oxygen, not food. It keeps the patient alive but doesn't make them stronger. The real wealth of a nation or a person lies in what they produce, not in what they can borrow or print. Smart investors understand this. They look beyond liquidity, driven gains, and focus on assets and ideas that generate lasting productivity, because in the end, when the excess liquidity evaporates, what remains is the true measure of wealth, the capacity to create value that endures beyond the money supply. Every economy moves through cycles of debt, short-term cycles that last about a decade and long-term cycles that can span 50 to 100 years. Understanding where we are in that long-term debt cycle is essential to understanding why the global economy feels so strained today. Debt, in its early stages, is a powerful tool. It allows individuals, businesses, and governments to invest in productive activities that generate more income than the cost of borrowing. But over time, as confidence grows and interest rates fall, people borrow not just to invest, but to consume and to sustain lifestyles that their real income can no longer support. That's when the debt machine begins to run on hope rather than productivity. Right now, we're nearing the end of a long-term debt cycle. For decades, countries have been accumulating more debt than income growth could justify. Governments borrowed to fund deficits, corporations borrowed to buy back their own shares, and consumers borrowed to keep up with rising living costs. All of this worked as long as interest rates stayed low, and central banks could intervene to keep liquidity flowing. But as debt piles up, it creates a paradox. The more debt you have, the less effective each new dollar of borrowing becomes. When debt grows faster than income, it means future growth is being borrowed from the present. That's sustainable for a while, but eventually the future arrives. At that point, either the debt has to be paid down, restructured, or inflated away. None of these outcomes are painless. Paying it down slows growth, restructuring it causes defaults and instability, and inflating it away erodes purchasing power. Yet these are the only mathematical ways to bring an over-leveraged system back into balance. In the current environment, most governments have chosen the path of least resistance, borrowing more and printing more money to cover it. That strategy can delay the reckoning, but it can't prevent it. Every time interest rates rise, even slightly, the cost of servicing that enormous debt grows exponentially. It becomes a self-reinforcing trap. The economy can't handle higher rates because the debt load is too heavy, but keeping rates low just encourages even more borrowing. That's how a debt cycle turns into a long-term debt crisis. If you look at history, this pattern is remarkably consistent. The same thing happened in the late stages of the Roman Empire, in 17th century Spain, in pre-evolutionary France, and during the decline of the British Empire. Each of these powers expanded their influence through credit, financed wars, and maintained lifestyles that exceeded their productive capacity. Eventually, the burden of debt became too heavy, and their currencies lost credibility. Once people no longer trusted the value of money or the sustainability of debt, the system had to reset, often through painful social and political change. Today, we see similar signs in the global financial system. Government debt-to-GDP ratios are at record highs. Central banks are trapped between fighting inflation and avoiding recession. Public expectations are high, but trust in financial and political institutions is weakening. When a system reaches that stage, it doesn't take a massive shock to trigger a shift. Just a small loss of confidence can start a chain reaction. The truth is that debt is not inherently bad. It's simply a tool. But like any tool, its usefulness depends on how it's used. When borrowed money goes into productive investments that create real future income, it strengthens the system. When it goes into consumption or speculation, it weakens it. We're now living through the consequences of decades of debt used for comfort rather than productivity. The result is an economy that feels like it's growing, but much of that growth is borrowed time. Eventually, every debt cycle ends the same way, through restructuring, inflation, or default. The question isn't whether the cycle will end, but how prepared we are for it. Smart investors and policymakers recognize that we're near the top of the long-term debt mountain, and they're adjusting accordingly. They're focusing on real productivity, diversification, and resilience, because when debt can no longer sustain the system, only genuine value creation can. Smart money never moves impulsively. It moves deliberately, guided by data, patterns, and a deep understanding of cycles. Throughout history, the wealthiest and most resilient investors have shared one common trait. They move before everyone else sees the turn. Right now, the global financial landscape is shifting beneath the surface. Most people are still focused on the short-term noise, stock market rallies, interest rate announcements, and central bank statements. But those who study history, who see the bigger picture, understand that these are just surface ripples of a deeper current. That current is the great reallocation of capital, the quiet movement of smart money away from overvalued, liquidity-driven assets and toward real, tangible, productive value. When liquidity is abundant and credit is cheap, almost every asset class rises together. Stocks, bonds, real estate, even speculative instruments like crypto, they all thrive when money is easy. But as the cycle matures and central banks begin to tighten or the effectiveness of cheap credit diminishes, the tide turns. This is when you begin to see separation. Weak assets, inflated by cheap money, begin to crumble, while strong cash-generating, value-based assets start to outperform. Smart money moves before that moment of separation. It doesn't chase trends, it anticipates reversals. The movement we're witnessing today is not random. Institutional investors, sovereign wealth funds, and ultra-high net worth families are quietly reallocating their portfolios. They are moving away from financial assets that depend on constant liquidity, such as speculative tech stocks or debt-heavy corporations, and into assets that hold intrinsic value. These include commodities, agricultural land, critical minerals, energy infrastructure, and data networks. The logic is simple. When the monetary system loses its ability to stimulate growth, real assets that produce something essential become the foundation of stability. This shift mirrors what has happened at every major turning point in economic history. In the late 1970s, when inflation eroded the value of paper assets, investors who moved early into real estate, commodities, and energy came out on top. In the aftermath of the 2008 crisis, those who bought productive technology companies at depressed valuations when liquidity was tight reaped extraordinary gains as the next expansion began. Each era has a moment when liquidity dries up and perception gives way to reality. Those who recognize that moment and move capital before the crowd are the ones who preserve and multiply their wealth. What's different this time is the scale and global nature of the shift. The post-2008 monetary experiment created an unprecedented expansion of liquidity across every major economy. Central banks became the largest players in financial markets, distorting risk and reward signals everywhere. Now that inflation and debt pressures are forcing them to withdraw, the entire system is being repriced. The free money era is ending, and smart money knows it. That's why it's diversifying geographically and sectorally, spreading exposure across different currencies, countries, and asset classes that can endure the volatility ahead. This movement isn't driven by fear, it's driven by awareness. Smart investors understand that cycles don't end, they evolve. When one source of return becomes exhausted, another emerges. The key is not to resist change, but to adapt faster than the majority. Most retail investors, unfortunately, react emotionally. They buy at euphoria and sell at panic. Smart money does the opposite. It accumulates quietly when fear dominates and exits gradually when optimism returns. We are now in the stage of transition where the majority still believes in the power of liquidity, while the minority has already begun securing real value. Over time, that minority becomes the majority, but by then, prices have already adjusted. The lesson here is timeless. Wealth doesn't vanish during economic resets. It merely changes hands. Those who understand the cycle and act early capture it. Those who cling to outdated assumptions lose it. Smart money moves not because it predicts perfectly, but because it reads the signs of the cycle with clarity and discipline. It moves before the storm, not after the flood.